The next video that we're going to focus on something called as marginal standing facility. So before we move on to try and understand what is marginal standing facility, it is extremely important that we understand a little background on the repo first for us to try and understand the impact a little better. Okay. Now I'm sure majority of you all viewing this video somewhere know what a repo is, but we're gonna go a little deeper into the subject to try and understand what is repo and how is it exactly done in the market. Okay, so what's a repo? So let's say the central bank of the country, which is Reserve Bank of India, wants to control liquidity in the market. How do they do it? They do it with the repo rate. Now what exactly happens? So let's say RBI, and then you have a commercial bank, let's say any commercial bank, ICICI. Now what's a repo rate? Repo rate is the rate at which RBI lends money to the commercial bank. Okay, so say for example the commercial bank wants 500 crore rupees. Commercial bank borrows 500 crore rupees overnight, okay, or maximum for 3 days. So if it is lent on a Friday, it becomes a 3-day, but typically repo is overnight. So when RBI lends money to commercial bank overnight, that 500 crore rupees which is lent, that does not go free of cost. Hence the interest that the commercial bank pays RBI, that interest is called the repo rate. Okay, and this entire transaction which takes place is called the LAF, which is Liquidity Adjustment Facility. Okay, the process is called LAF. So it's the LAF process through which commercial banks borrow money from RBI at the repo rate. Now typically in the books we've seen, what's a repo? Repo stands for repurchase agreement. And in my assignments of trainings that I've been doing at various colleges across, I've been asking students what is a repurchase agreement, and majority of those guys have failed to understand what's a repurchase agreement and how is repo called a repurchase agreement. So let me throw some light on that before we move to marginal standing facility. So what happens is when commercial banks borrow from RBI, they have to keep something as collateral with the RBI for them to borrow money. Now what do they keep as collateral? They keep securities permitted under SLR as collateral. Now first let's try and understand what is SLR. SLR stands for statutory liquidity ratio. Okay, so what happens in a statutory liquidity ratio? Let's say for example a bank has 100 rupees of total deposits, okay, which in the banking language they call as NDTL. What does NDTL stands for? NDTL stands for net demand and time liability. Okay, what's net demand and time liability? Let's say the bank has 100 rupees in total as deposits. Now these deposits can be either a savings account or a current account or a fixed deposit, etc. Okay, all this is a liability to the bank. Now what's a net demand liability? Demand liability typically comprises of savings account and current account, which can be demanded by the customer at any point in time. Now what is time liability? Time liability is typically a fixed deposit which is fixed for an X time. Okay, so let's say bank has 100 rupees as NDTL. Okay, out of this 100 rupees, the bank has to keep some money separate under statutory liquidity ratio. So currently the statutory liquidity ratio is 23%, which means out of the 100 rupees that the bank has to keep to 23 rupees under SLR, statutory liquidity ratio, which is one of the policies that the RBI follows. Okay, which means that this 23 rupees has to be in SLR. Now SLR has three components. Either the bank can keep money in cash, so out of the 100 rupees the bank will keep 23 rupees in cash, or can put money in gold, or permitted securities by the government. Now which are the permitted securities by the government? Treasury bills, Government of India bonds, or state development loans. which means out of the 100 rupees that the bank has as NDTL, bank has to keep 23% as SLR. SLR can be cash, gold, or permitted securities, which are treasury bill, government of India bonds, or state development loans. That means out of 100 rupees, 23 rupees has to be in this. Now, why is repo called a repurchase agreement? Is because the permitted securities, which is treasury bill, government of India bond, and state development bond, has to be kept as collateral when the bank borrows money from RBI at the repo rate using the LAF facility. So let me explain that to you. So say for example, a bank has 100 rupees as NDTL. SLR is 23%, which means 23 rupees of 100, which means bank will have to keep 23 rupees. Let's say bank has kept the entire 23 rupees in the treasury bills, government of India bonds, and state development loans. Now what happens is, when the commercial bank wants to borrow money from RBI, we've understood that the commercial bank will have to put some collateral. What collateral will they put? They'll have to put any of these securities as collateral. But now try and understand, if they put any of these securities as collateral with the bank, their SLR will come down. But the SLR is mandated to be at 23%. So what the bank will have to do is, bank will have to buy some more SLR. So the bank will either buy some more treasury bill or some more government of India bonds or some more state development loan bonds, and will give it to the RBI as collateral, making sure that the SLR is still at 23%. Okay. Now, why is it called a repurchase agreement? It's called a repurchase agreement because when commercial bank return the money to RBI, RBI will give the collateral back, and hence it is called a repurchase agreement. So let's say if the bank wants to borrow some money from the commercial bank, okay, let's say the bank wants to borrow 100 rupees. So the commercial bank wants to borrow 100 rupees from RBI. Okay, there are certain rules in place, which is margin, which means that if the commercial bank wants to borrow 100 rupees from RBI, they'll have to put some collateral, but what value of collateral will have to be put? It is further bifurcated. So if the banks give treasury bill or government of India bonds as collateral, banks will have to pay 5% margin, and if they give state development loans at collateral, they'll have to pay 10% as margin, which means that if the commercial bank wants to borrow 100 rupees from RBI and it is willing to give treasury bills and government of India bonds as collateral, they'll have to give 105 rupees worth of collateral. And if they're giving state development loan as collateral on 100 rupee of borrowing, they'll have to give 110 rupees of collateral. Okay, that's how the entire repo works, and this entire process is called liquidity adjustment facility, which is LAF. Now what happens is, under repo, let's assume that the bank's been borrowing 90 crore rupees from RBI, or rather the RBI is giving 90 crore rupees under the repo to banks, 90,000 crore rupees. Now say for example, if there is some liquidity crunch, or if the bank requires more money than the 90,000 crore rupees that the RBI is willing to offer, where do they borrow that money from? Okay, to address this issue, in 2011, RBI introduced something called as marginal standing facility. Now what is marginal standing facility? Over and above the 90,000 crore rupees that the RBI is willing to give under the repo to the bank, if they want to borrow more money, they can borrow more money overnight, okay, from the RBI under the marginal standing facility window. Okay, but they'll have to pay 1% more over and above the repo rate. So let's say for example, if the repo rate is 7.25% and the banks are borrowing 90,000 crore rupees in repo, at 7.25%, but they want to borrow more than 90,000 crore rupees. Let's say they want to borrow 1 lakh crore rupees. So the additional 10,000 crore rupees which has to be borrowed will be borrowed under marginal standing facility, okay, which works exactly same like repo. But over here, what is the interest that they'll have to pay? The interest that they'll have to pay is 100 basis points or 1% more than the repo, which is 8.25%. Now this is one difference between repo and marginal standing facility, which is that the interest rate on marginal standing facilities is a little higher than the repo rate. The second difference is that in the repo, you had to pay SLR over and above the 23%. That means you had to buy additional treasury bills, government of India bonds or state development loans over and above the 23% of SLR to get the repo 90,000 crore rupees. But in marginal standing facility, you don't need to buy more than 23% of SLR. You can use the securities from these 23%, give as collateral to RBI from the 23%, and can borrow money under the marginal standing facility. This is how it is a little different from the repo. Now what happened is late Monday evening, RBI announced that it is raising the marginal standing facility by 200 basis points. 200 basis points is nothing but 2%, which means that now the repo, which was 7.25%, and the marginal standing facility, which was 8.25%, now the new marginal standing facility stands at 10.25%. They also said that under the repo window, okay, banks can borrow maximum 1% of their NDTL. Okay, which means the banking system has, let's say, 7,50,000 crore. The banking system has, let's say, 75 lakh crore rupees in the banking system. How much maximum they can borrow under the repo? 1%, which is 75,000 crore rupees. Okay, which means any more requirement over and above the 75,000 crore rupees will have to be borrowed under the marginal standing facility, which was at 10.25%. So now understand, the first thing that they did was from 90,000 crore rupees that was available under the repo before, they lowered it down to 75,000 crore rupees by keeping this as a cap, by saying only 1% of NDTL can be borrowed under repo. So now from 90,000 crore that they were borrowing at 7.25%, okay, and the surplus that they were borrowing at 8.25% has gone down to only borrowing 75,000 crore rupees at 7.25%, and the remaining, anything that is over and above 75,000 crore rupees will have to be borrowed at 10.25%, which is 300 basis points higher than the previous 100 basis points higher when they started MSF. Okay, which means first it was 7.25 and 8.25, which was 100 basis points difference between repo and MSF. Now it is 7.25 and 10.25, which is a 300 basis points difference, which means that the loan for overnight that the commercial bank takes from RBI has become extremely costly, and at the same time difficult, is because under repo they can borrow only 1% of NDTL, and they've also put up a cap that under MSF also they can borrow only 2% of NDTL, which means the maximum borrowing that the bank can do is 3% of NDTL, including 1% of repo and 2% of MSF, okay, at increased interest rate of repo being the same, which is 7.25, but MSF at 10.25. This is what created a problem in the entire market, where you saw yields going up from 7.5% to 8%. You saw banking stocks falling 5%. You saw Nifty and Sensex roughly falling 1.5%. Now let's try and understand why was this entire situation put into perspective, or why was this entire thing done? The MSF was increased by 200 basis points to curb liquidity. Okay, the central bank wanted to reduce the liquidity in the market, which is why they increased the MSF by 200 basis points, which will make loans costly for the banks, and hence the bank will take a little less loan. Or even if they take loans under MSF, when they give those things out as loan on car loans or home loans or all, loans will become expensive and hence the liquidity will fall. That was the entire reason why the MSF was increased 200 basis points. But the point is, why did the RBI want to curb liquidity? The RBI wanted to curb liquidity because they wanted to support the rupee. We've done in the last two videos that we've done so far that decreasing liquidity in the market helps the rupee. Okay. And if you all have forgotten, let me just give you a little brief very quickly. Let's say I reduce the liquidity in the market. That means there is a reduction in rupee supply in the market. If the rupee supply reduction is there in the market, rupee will automatically come down, and in the currency language, rupee will appreciate. Okay, so that was the entire intention. But what happened? Post the Monday rollout that they did, on Wednesday, RBI had few bonds that they were supposed to auction under the open market operation to curb more liquidity and to remove more money out of the system. But the entire auction failed, and RBI did not sell a single bond on Wednesday because people who are participating in the open market operations, specifically banks, wanted higher yields. So they had quoted that they wanted higher yields, and RBI rejected all their quotes and did not sell a single bond on Wednesday. Similarly, they had an auction on Thursday also. On Thursday, they were supposed to sell 12,000 crore worth of bonds. Okay, but only 20% of this 12,000 crore got sold. Again, for the same reason that the investors were asking for more yield, and the remaining 80% bids were rejected. So what is happening is, somewhere post the MSF hike of 200 basis point, which was to be supported by open market operations on Wednesday and Thursday, it is failing because RBI is not able to suck more liquidity out of the system because bids are getting rejected and the entire thing is failing. So now what are the options left with the RBI to control liquidity in the market and to help the rupee? There are two more options available. First is issuing dollar bonds. The second option, which is left with the RBI or the government, is to increase the CRR for the banks. CRR currently stands at 4%. Okay, CRR is the cash reserve ratio, which means if the bank has 100 rupees of NDTL and if CRR is 4%, the bank has to keep 4 rupees with RBI, on which RBI pays no interest. So if the CRR is increased from 4% to 4.25%, every bank will have to keep 0.25% of their NDTL more with RBI, which is another method of reducing the liquidity with the banks and hence the liquidity in the market. I hope you've understood the entire thing. What's a repo, what's a LAF, what's an MSF, and why did it actually create a problem in the debt and the equities market. Wait for more videos. Thank you so much.